Hello, everyone. This is Kathy Fagan. I'm an annuity specialist here at Art Jetter and Company. Thank you for joining us on this highly anticipated presentation from Athene. Today, we'll be talking about the basics of annuities to include the Annuity Spectrum, the advantages of fixed index annuities, and how to choose an annuity based on your client's risk profile. We're joined by Scott McClure, Business Development Wholesaler with Athene. Before I turn it over to Scott, I just want to mention that if you have any questions throughout the presentation, you may type them into the chat box on your screen. All questions will be answered at the end of the presentation. Now, without further delay, I'm going to turn it over to Scott.
Well, thank you, Kathy. First of all, let me say thank you to you and everyone at Art Jetter for being such a great partner with us here at Athene. We very much appreciate your support and your help in our annuity sales. And just like to say, Art Jetter is a very, very good quality partner to have with your annuity sales going forward. So having said that, my name is Scott McClure. I'm your business development wholesaler here at Athene. Today we're going to talk about annuity basics. So we're going to jump right in and just kind of go over how fixed index annuities work and some of the moving parts as well. So without further ado, thank you so much for the opportunity to present to your group. Again, it's Scott McClure with Athene Annuities. We're always here to help out, but the folks at Art Jetter are always the ones who can answer your questions or help out with any of your annuity business going forward. So let's start out talking about annuities. Why an annuity? Well, let's go back a couple of years. In 2016, there were over $220 billion sold in U.S. annuities in the United States. 117 billion were fixed and fixed indexed annuities. So the key reasons to purchase a fixed indexed or fixed annuity are going to be safety and protection as well as income. So how are those annuities typically sold to the general public? Well, the carrier is going to be the one who develops the product, and then we go through an IMO, a broker dealer, or a bank to the agent and advisors to the customer. So for you, it's going to be Athene through Art Jetter right to the agents, okay? So an annuity is a contract between an individual and an insurance company. In exchange for the premiums paid, the monies can accumulate in the contract on a tax-deferred basis. Annuities are tax-deferred, may be paid out all at once or in a stream of payments over time. So we do have accumulation products. We also have income products, and you could also annuitize contracts. But the common uses for annuities are going to be saving for retirement to create a dependable retirement income stream. And also we see a lot of rollovers from IRAs, from 401ks, from all that qualified money that you save while you're saving for retirement with your company. A deferred annuity, there's going to be two kinds, immediate and deferred. A deferred annuity, they generally accumulate on a tax-deferred basis for more than 1 year before payments begin. Often it's much longer than that. We have people who keep their annuities 20, 30, 40 years. Payments can come via withdrawal or annuitization. Now, an immediate annuity, generally speaking, we call that a SPIA, a single premium immediate annuity. Payments for that begin within 12 months of the policy issue. Those are generally used to turn a bucket of money into an income stream, and that can be for a certain amount of time or for lifetime. So different ways that you can set up those immediate annuities. Annuitization. Annuitization is when you annuitize your contract. You essentially sign the money over to the insurance company, and it's going to convert an annuity balance into a stream of payments. Now, those payments can continue for a fixed period of time or guaranteed for life. But again, when you annuitize, you take a settlement option, and then you have that settlement option going forward. Additional purchase considerations. There are annuities that are single premium and also annuities that are flexible premium. So what do we mean by that? Well, a single premium annuity, it's purchased with a single lump sum payment. Now, just to clarify that a little more, you can have more than one source of premium. For example, you could have two traditional IRAs and move them into one contract, even if it's a single premium. But once it's issued, you cannot add to the contract. So that's what we think of as a single premium. Purchased with a lump sum or a lump sum payment. Some single premium annuities accept additional premiums during a short specified period of time. For example, some will allow you to add premium during maybe the first year. Again, there are many varieties of annuities, but generally speaking, a single premium annuity is going to be, once it's issued, you can't add any more money to it. Here at Athene, most of our fixed index annuities are single premium. We always say, as you can't add more money to them, because the contract's already been taken out, you can, though, open another annuity. So you can always add another annuity to that client's portfolio. A flexible premium annuity is going to accept payments for longer periods of time. Now, that could be 1, 2, 5, 10 years. Some will accept payments for the entire contract. So just have to check the specifications on the contracts that you're writing. Issue age guidelines, another thing that you have to think about with annuity contracts. The contracts often define a minimum and maximum issue ages. So maximum issue ages usually between about 80 and 90. Some carriers go a little bit higher than others. For us, fixed index annuities, the highest we'll go on a fixed index annuity is 83, and the highest that we go on a fixed annuity is 85. So just don't feel like it's a good idea for folks older than that to be getting into a surrender charge period. So let's talk about some tax basics of an annuity, and we'll talk about accumulation versus payout. But during the accumulation period, interest earnings accumulate on a tax-deferred basis. That's a big plus for annuities. They are tax-deferred. No taxes are due until the funds are withdrawn. So any gains that you make inside the annuity contract are tax-deferred until you take those gains out, at which point they would be taxed, but there's no 1099 for those gains, and that interest is compounded. You earn interest on the dollars that would have been paid in taxes, so it helps you to accumulate more quickly. Now, during the payout period, if payments are withdrawn, earnings taxable as ordinary income in the year that you take it out. Withdrawals before the age of 59 and a half may incur a 10% IRS tax penalty. Again, that's a special treatment for an annuity. The IRS lets you defer taking those payments. They tax defer all the growth until you take the money out. But if you do take it before 59 and a half, there could be that 10% IRS penalty. Now let's talk about non-qualified versus qualified contracts. For non-qualified, that's going to be after-tax money, personal investment money that clients generally just have in their savings or checking account. Premiums are returned tax-free. Again, you've already paid taxes on that, so you're not double taxed. The earnings on non-qualified contracts are taxed as ordinary income when you take those gains out. Again, it's going to be tax-deferred until you take the gains out, at which point they will be taxed as ordinary income. On a qualified contract, an IRA, a 401k, etc., usually funded with those pre-tax dollars, all payments are taxed as ordinary income. Again, no tax has been paid on the premium or the gains at this point. And the annuity does not provide additional tax benefits on a 401k or an IRA. They're already in a tax-deferred vehicle. So withdrawal and surrender charges. Most annuities assess a charge if withdrawals are made during an initial surrender period. Charge is typically a percentage of the amount withdrawn. Surrender periods vary by contract. Common surrender periods are from about 5 to 15 years. Now, most contracts are going to offer liquidity during the surrender charge period. Most contracts allow some liquidity before the surrender charge applies. Free withdrawals are generally in the 5 to 10% of the account value range. Again, some annuities will have a little different features, so some could be a little more, some could be a little less. But remember, all withdrawals are subject to tax on earnings, and withdrawals taken before the age of 59 and a half may be subject to an additional 10% IRS penalty. So let's talk a little more about the additional liquidity provisions. There are many waivers that are available on different contracts. And again, this is where you want to check the fine print on any contract that you're writing just to find out what the waivers may be. Many contracts include special benefits to aid with financial needs that arise under various circumstances. Waivers may allow for penalty-free withdrawals up to specified limits. if certain conditions are met. So the common waivers that we see and are available in most of our contracts are going to be nursing home, confinement waivers, terminal illness waivers. Some have home health care. Certainly less are going to have home health care than their nursing home or confinement waivers. Waivers availability and terms may vary by company, by contract, by state where the contract is issued, or by other criteria. That's real important. There are certain states that don't like to have health-related things in their annuities, so you have to check to make sure that those are available in the state that you're writing the contract in for your client. RMDs, required minimum distributions. The tax code requires most qualified plans to begin paying income at age 70 and a half. Many issuers allow RMDs to be taken without penalty. That is the case here at Athene. All of our contracts are RMD friendly, so your clients are never penalized if the IRS is making them take a required minimum distribution. Talk a little bit about income riders. Many contracts offer income riders, optional benefits usually available for additional costs, but not always. Some have free income riders as well, that guarantee a specific minimum level of income, often for life. These are a kind of a nice new feature of income products that allow the clients to have a lifetime income stream guaranteed without having to actually annuitize the contract. So let's talk a little bit about the bonus provisions. May apply under certain conditions for these bonus provisions. Common bonuses, premium bonuses. So an additional value credited to the contract at issue. Many of our contracts are going to have a premium bonus. May also be recaptured if the withdrawal is made before a specified period of time. So not unlike a surrender charge schedule, a lot of the bonuses will have what they call a vesting schedule. And your client will need to keep the contract over a certain number of years to be completely vested in that bonus. So if they surrender the contract early, they could give up part of that premium bonus. There's some persistency bonuses as well, which add additional value credited to the contract if the contract stays in force beyond a specified time frame. There are also income bonuses. So with the new income riders, additional value can be applied if certain withdrawal or annuitization payment options are elected. A lot of times you may see a bonus on an income rider or something of that sort. So availability varies by contract and state for all of these things. Let's talk now about the guaranteed minimum withdrawal benefit riders. These are your income riders, become very, very popular in the last 20 years on annuities. A popular optional feature on many fixed indexed and variable annuity contracts, usually offered for an additional cost, but again, not always. Some of those riders do come for free. Guarantees a specified level of income, usually for life. So applicable even if the contract value reaches zero. So what that means is once your clients are in an income product, and this is, we're generalizing here, normally speaking, if the client turns on that lifetime income, and even if their account value drops to zero, they're going to have a guarantee with that income rider that they will be paid that same amount of income for as long as they live. So payments payable as withdrawals, not annuitization. The annuitant maintains control over the remaining contract value. So again, one of the benefits of using an income rider over annuitizing is you still have complete control over the contract, and any money that's left over when the client may pass away would go to their named beneficiary. So contract defines a maximum amount available for withdrawal, often based on the annuitant's age at the time guaranteed payments begin. Payout rates increase if income is taken at older ages. So the longer that those clients defer taking the income, generally speaking, the bigger their income payments will be. And also the length of time the contract was held before the guaranteed payments begin. So income factors generally roll up every year by a specified amount. Again, all these contracts are going to be different, so there are different ways that they will roll up. We have contracts that roll up generally for about 20 years before the client would want to take income. Of course, they can take income in certain contracts right away. Certain contracts they have to wait a specified number of years. But excess withdrawals may decrease the value available for subsequent guaranteed payments. So the way that works is if you are using an income rider, if you take excess withdrawals, even if they're penalty free, they are going to reduce your future income payments. So just be aware of that. When you do take those excess withdrawals, generally speaking, it's going to reduce the income account value pro rata proportionately. So would have smaller income payments going forward if you take excess withdrawals. Also, let's talk a little bit about the death benefit. There usually is a death benefit if the annuitant dies before the contract maturity. Generally, if you have named beneficiaries, it's going to bypass probate. Again, if it's properly named as a named beneficiary, and annuities will be paid directly to the beneficiary. Then there's a few different ways that can happen. A lump sum, a periodic payment. Sometimes you can get a larger sum if you take it over, for example, 5 years, and then also some will give lifetime payouts. So now let's talk about a few different types of annuity contracts. First of all, we've got a fixed contract. This is where the owner earns regular interest, company declares interest rate, and the company may offer multiple terms, usually 1 year or longer. Again, that's just a straight fixed interest rate. We call them multi-year guarantees very often, where we may offer a client a given interest rate for 3, 5, 7 years, and it's guaranteed for all those years, just a straight fixed interest rate. We also have fixed indexed annuities. These are becoming the most popular now. And the owner earns regular interest. The interest is based on a portion of the return of one or more indices. So you and your clients will get to pick what indexes they use and at what percentage you like to use. And generally speaking, you get to participate in a certain amount of it, or there could be a cap. The company defines how the index earnings will be shared. The company guarantees that interest credit will never be less than 0. So that's where we say 0 is your hero with a fixed indexed annuity. In a variable product, you can actually lose money. In a fixed index annuity or fixed annuity, you will not lose any money from any index movement. Then we also want to talk a little bit about variable annuities. The owner can earn interest depending on the return of the sub-accounts. This is where the owner is going to pick what investment options they would like to use in their sub-accounts. Sub-accounts are similar to mutual funds and may rise or fall in value. Variable annuities are considered securities and require securities licenses to sell them. So anyone who's going to be selling a variable annuity would need at least a 6 and a 63 as well as their life license to sell that product. Let's talk a little bit about interest rates. Initial rates. Companies guarantee that the initial deposit will earn a specified rate for a specified time, typically 1 year or longer. This is normally going to be on a fixed annuity. Renewal rates after an initial guaranteed period, the insurance carrier will declare new rates for subsequent periods. They can be higher or they can be lower than the initial rate, and they may have some different terms in that initial period. So they may only be good for 1 year and then have another declared rate, whereas if you're in a multi-year guarantee, it may be guaranteed for the entire 3, 5, 7 years. Minimum contract guaranteed value. Company declares a minimum guaranteed rate below which the crediting rate will never fall. It's established at the time of purchase and applies for the life of the contract. Also, we'll talk a little bit about market value adjustments. This is a charge that may apply when money is withdrawn or transferred before the end of the guarantee period. That's defined by the company that issues the contract and typically related to changes in interest rate over time. If general interest rates have risen since the guarantee was established, MVA will result in a charge or deduction to the contract value. If interest rates have fallen since the guarantee was established, MVA will result in a credit or increase in the contract value. So now let's talk a little bit about the spectrum of annuities in general and risk and potential gains for your clients. So what is going to be a low or moderate return, low risk type of product? Well, example would be CDs, bonds, and fixed annuities, okay? Again, very safe products, low risk, but again, maybe not the highest return potential. Then let's look at something with a little bit more of a moderate return, but no market risk, and that's going to be your fixed indexed annuity. That's the one that's going to offer your clients safety, but also a potential for a nice upside gain as well. So If your clients are looking for something with a higher potential gain than a fixed indexed annuity, then they're going to need to look at something that's a little more high risk, and that would be purchasing stocks in the stock market, mutual funds, or variable annuities as well. With all of these products, the investment risk will be with the client. If they pick great stocks, they may do well, but as we know, a majority of clients may just be picking random stocks or mutual funds, and so it's kind of on a whim how well they do. But they certainly have all of the investment risk in a variable product, whereas in a fixed indexed annuity, all the investment risk is with the insurance company. So let's talk a little bit about basic terms, initial and renewal rates. As with fixed annuities, indexed annuities include term lengths, generally 1 year or more. We have products here at Athene from about 5 to 15 years. Initial cap rates, those are assigned to an annuity contract at the time of purchase and applicable to the terms selected. Renewal cap rates, those are going to be declared after each index term, applicable to the next index term. So if your client's in a 1 year strategy, they'll get an option to change that after the first year. If they're in a 2 year strategy, they'd have an option to change that after 2 years. Minimum guaranteed values, declared at contract issue and applicable for the life of the contract, may be set by a formula. So just remember, it's not in the stock market in a fixed indexed annuity. Interest rates are linked to a portion of the upside performance of an outside market index. So what that means is your clients are going to pick an index or a number of indexes that they want to track, and they will get some or all of that index return, but we cover 100% of the downside for them. So the potential for a greater greater interest crediting compared to traditional fixed annuities. And then the indices vary by company. Most companies are going to offer the S&P 500, probably the best known index in the world. The Dow Jones Industrial Average, NASDAQ, Hang Seng, Euro Stoxx 50. There are a lot of different indexing options available. Indexes can move up or down. So the accumulated value increases as indexed interest is credited based on upward movement of the index. It's linked to, but not equal to, the market index return. The accumulated value does not decrease if the index movement is a negative or flat. Again, that's where we say zero is our hero. If your clients were in a variable product and the market went down, they're going to lose money. Here in a fixed index annuity, as we track that index, if the index decreases, we're going to cap those clients at a 0% return, and there won't be any losses for them. That is one of the great things about a fixed indexed annuity. So again, let's talk a little bit about fixed indexed annuity basics, and this is going to be how we credit fixed index annuities: caps, spreads, participation rates. We'll go over all of that. The interest credit equals, if you have a cap, the return of the underlying index up to the stated cap. So the example is, if the cap is set at 5% and the index earns 3%, the client will get the full 3%. If the index earns 5% and the cap's 5%, they'll earn that full 5%. Now, if that index did 9% and we had a 5% cap on it, interest would be credited at 5% because the interest is capped at 5%. A cap is going to put an upper limit on what the clients can earn. And then we also have spreads. The return of the underlying index less the stated spread is how that works. So the example is, let's say we have a 2% spread. If that index returned 3% and we had a 2% spread, the client would get a 1% interest. That's the 3% minus the 2% spread. The client gets 1%. If the index earned 5%, again, we take that 2% spread out. It's kind of a hurdle rate is how I like to look at it. And if there was a 2% spread and the index earned 5%, the client would earn 3%. If there was a 9% gain, 2% spread, the client would earn 7%. So that's how spreads work. We also have participation rates, and that is what we use for majority of our contracts here at Athene. The return of the underlying index is multiplied by a stated participation rate. And the reason we like this is there's no cap, there's no upper limit on what the clients can earn. Simply, in this example, let's say there's a 50% participation rate. If that index earned 3%, your client would earn 50% of the 3%, which would be 1.5. That's a 50% participation rate. If the index earned 5%, the interest credited to the client would be 2.5%. Again, 50% participation in the index returns. And then if the index returned 9%, the interest credited would be 4.5%. Again, half of the 9 at 50% participation in the index return. So now let's talk a little bit about indexed interest crediting strategies. Approach used to measure the amount of interest credited to the annuity as a result of change in an index. So common strategies: fixed interest rate. We see a lot of one-year guarantees, point to point, increase from a specific date to 1 year later. So we see this a lot. Contract date to the next contract date. We look at the percentage of change between the indexes. Monthly averaging. We look at the change in the index comparing the beginning of the index value to the 12 monthly average index values. Monthly cap, same as the point to point, but on a monthly basis. After 12 months, we add up all 12 monthly percentages and divide them by 12, and that gives us the monthly cap average, okay? So again, annuity summary: safety and protection, provides upside potential with no risk of loss in a fixed index or fixed annuity. Can use them for income. They are tax deferred, has tax deferral, a death benefit options, and a number of liquidity options, free withdrawals, nursing home, terminal illness, confinement waivers, all those things we talked about earlier. And so that is the end of my presentation. I'm going to kick it back over to Kathy and open it up for questions. Are there any questions out there for me? Be happy to take those at this point. Thanks, Kathy.
You got it, Scott. Thank you. That was a great presentation. Lots of wonderful information on annuities. I'm not seeing any questions out here at this time. So again, thank you, Scott, for the presentation, as well as everyone who joined us today. We encourage all of you to start thinking about people who are a fit for the annuity solutions that were discussed during today's webinar. Our team is standing by. If there are any further follow-up questions or you'd like any illustrations or additional information regarding annuities, please call us at 800-228-0008. And again, thank you for attending and enjoy the rest of your day.